The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, this is Esther Gulius, a tax lady from EG Tax, and as you know, our whole job is get you to know more about taxes than any other major metro area in the world. I'll tell you, we are on it. We want to get you so that you're ready for 2018 because major changes. And so I'm joined in studio here with Tiffany Fabian and Christopher Fabian. Hey, guys.
Hey there, Esther.
Hello, Esther.
Hello, Christopher. So, all right. So today, unlike many of our shows where we have a live call-in, this is our email show. So we're going to talk about people's emails specifically geared to the 2018 changes. I mean, a lot of other things too, but we wanted to make sure that you know what's going to happen. And we really invite you, if you have any questions, you can email us through our website at egtax.com, or you can call the office at 632-7886. Our corporate office is open 9 to 5, Monday through Friday. And you can call anytime. We have live human beings who want to answer your questions. So whether you've gotten letters, and by the way, if you get letters, don't ignore the letters because that means that they lobbed the ball back into your court. And if you ignore it, they're not going to process your refund.
Yeah, a really good example, I did a client's tax return and she got a letter from New York State that she owed another $100. Because they were disallowing the personal exemption that she took when she came in. She showed me, and I said, well, that's not true. We just claimed the dependent exemptions. There was no personal exemption claimed. You shouldn't have paid this. So now we're fighting to get the money back.
Yeah. And that's kind of what happens, you know. It's interesting. I had a client the other day who bought an expensive house, and they took out about $200,000 worth of personal effects in the house in the state of New York, and then they paid the sales tax when they closed the deal. The state of New York sent this guy a letter for like $26,000 that they wanted the sales tax. So we had to prove that the sales taxes were paid at closing. So those kind of things happen, and you want to make sure that you have an advocate in your corner. And to ignore it means that if it's a bill, it doesn't go away, and as it ages, it gets worse because there's penalties and interest accruing.
Right. And
Chris, you were saying that, or Tiff, you were saying that we have some information about the healthcare
provision. Yeah, Chris, you can roll it out. This talks about confusing.
Right. You know, because we brought it up before on the air, and we've talked about it with the health mandate, whether you need insurance or you don't need insurance for 2018. Under IRS law, you still need health insurance or there's a penalty. President Trump signed his executive order stating for 2018 that you don't need health insurance. So right now it's up in the commissioner's hands to get it approved to whether or not you need health insurance.
But I understand in the tax law that was passed, though, the penalty is abated starting in 2019.
Right, but how President Trump put it in his executive order was for 2008.
Yeah, but the tax law that was passed.
Right, that's why
it's Trump.
It's so
Trump that.
Yeah,
but it is true. Right now, don't you feel like there's so many things that are in limbo? We don't know how they're all going to come.
Well, yeah, the healthcare navigator said that the health commissioner is the last person who has to sign off on it, and the new health commissioner was just approved by President Trump. However, it's being questioned as to his practices and his abilities, and so so that person who has to sign it yet hasn't been approved.
So what did you just say?
It's all in limbo. I hate to say that, but if you don't have
the bottom
insurance,
line is you need health insurance,
right?
And the thing is, if you're somebody that can't afford health insurance, there's an exception to penalty. Right?
Correct.
Right.
If you have had your utilities turned off, then there's a penalty. There's an exception to penalty.
Death in the family.
But if you are somebody that's struggling to make ends meet, many times you can get something that's like about $20 a month, correct?
Right. The Essential Plan is a phenomenal plan out there. Depending on what your income is and your family size, you can get insurance through the marketplace for, like Esther said, $20 a month. Then you can even include vision and dental for an additional $26. So you're looking $46 a month to cover every aspect.
And it's really good insurance.
Oh, it's phenomenal insurance.
I talked to people this last tax season who said I don't have insurance, and they might have made $15,000. They said because I can't afford it. I said, my gosh, you could have gone on the Essential Plan, but they had no knowledge of this, and that's why if you're listening to Ask the Tax Lady and when you're sitting around at the barbecue this summer and somebody says, oh, I just can't afford health insurance, tell them to come to EG Tax. We don't charge. We have 2 navigators on staff, and their job is to make sure that they get people in the least expensive, best suited health plan for you, and that's just part of something we do at EG
Right.
Tax.
And how many people have you seen who could have qualified for Medicaid but didn't want it?
Yeah,
or didn't know about it.
You want to talk about the best insurance out there. Medicaid is, no deductible,
and
no
it's interesting,
co-pays,
and Medicaid nowadays, the new Medicaid is not based upon your assets, it's based upon your income. So you could have $1 million in assets with no income and you'll qualify for Medicaid.
Yep.
For your health insurance.
Oh, it's unbelievable, and that's people have a hard time. And if you turn down Medicaid, you have to pay full price for whatever insurance you want to get through the marketplace. They will not give you a subsidy. So, I mean, people are looking to save money. There you go.
Yeah, right. Well, the thing is, sometimes the worst advice you get is from your friends. Because they might have said, 20 years ago we tried to get Medicaid, and that can't be true. But it is true. What happened with Obama is that he made it so that Medicaid, these health insurance plans, Medicaid is available to people based upon their income, not their assets. And so if you don't know if you qualify for health insurance and you need health insurance, give EG Tax a call at 632-7886, or you can get us through our website at egtax.com, Ask the Tax Lady, and we'll make sure that we plug you into Tiff or Karen. And also, if you're turning 65 and you need Medigap insurance, that supplemental insurance or 65, that you would get to help to fill in the gap that Medicare isn't covering. EG Tax will also help you with your Medigap insurance. And again, there's no charge.
That's right.
Right?
Yep.
All right. So why don't we go to our questions? Why don't we start with our email?
I have Arlene from Buffalo. Dear Esther, my father passed away about 3 years ago, but I received a W-2 from him in 2017. And again, he passed away 3 years ago. There were withholdings. Should I have done a tax return for him in 17?
That's weird.
Yeah.
So did someone not let their employer know?
I know I've seen it, like with labor union, like with teachers where their contract finally got settled and they went back 4 years ago and had to do retro pay. They issued the W-2 in the deceased person's name because they didn't realize they were deceased.
So what would you suggest that they do, Chris?
They have to open up an estate for the person and file an estate return to claim the income and the withholding.
So to open an estate means that you contact the Internal Revenue Service. They should have provided you with an employer ID number anyway in the name of the estate. And so you have to do a 1041. When you're alive, you do 1040s. When you pass away, the money that you generate after your death is on a 1041. So on the 1041, you're going to list the wages, and depending upon the amount of wages, you should be able to get the money back. If it was a large amount of wages, you may find that you're going to end up paying taxes.
So does that mean the beneficiaries are going to have to pay the taxes on, they're going to get a K-1, and the beneficiaries are going to have to eat the wages, right? That earnings.
Well, you could elect to do a distribution from the estate because it's the final year, and then the withholdings would all come back to the estate, and then the beneficiaries would pay tax on the wages.
Yikes.
But it really isn't that confusing. But the bottom line is,
For
after
you.
you pass away, any income that you make prior to distributing all the assets would have to be reported on an estate return, which is called a 1041, and EG Tax, of course, can help you with that.
Right, and we got to take a fast break, and we will be back after this message.
Hi, I'm Esther Golias, the tax lady from EG Tax, and this is one of we're answering emails, and it's as opposed to taking live phone-in calls. Now, next week we'll be back with your live calls, so make sure you jot them down so you're ready for next week. But what's great about answering the emails, you'll find that you can kind of hear us thinking about how tax laws are and all the nuances in the tax law, and I think you'll find it interesting. It's interesting to know that a lot of people, everything in politics is kind of public relations. And so initially when they first passed the tax bill, they made it sound like it was so simple. The truth is, the only thing that really changed was they eliminated the personal exemption, doubled the standard deduction. The itemized deductions are still there, including medical, property taxes capped at $10,000. Mortgage interest is still deductible. Charities are still deductible. Miscellaneous itemized deduction, if it's for gambling, is still deductible. And casualty losses, if it's a federally declared disaster area. The only thing that's in limbo right now is employee business expenses, and that should be interesting because if you're an outside salesman, over-the-road trucker, and you're incurring a lot of expenses for your job, you would be the person that's being targeted for this elimination of the deductibility of those items. And so we'll talk about that, and so that you're aware of what you can do. And there are things you can do. Mm-hmm. Right?
Yep. You could approach your employer and ask to be moved to an accountable plan and get an expense check and maybe have them lower your wages, but it all would wash out the same in the end.
If you were getting paid $100,000 and then you had to pay all your own expenses, okay, because you're maybe an outside salesperson, and those expenses were $20,000 a year, but the employer says, I'm not paying those expenses, I'm paying you $100,000. It behooves you to get a pay cut down to $80,000 and a reimbursement of those $20,000. You're still getting $100,000, but it's in a different way. The $20,000 reimbursement then isn't deductible, but it's not taxable.
Right,
and it saves you the FICA as well.
Right, but then the employer gets to write off the $20,000
as well.
So
those are things. And again, if you're an employee and you want us to come talk to your employer, we would be very happy to, because we want to see this to be equitable. Mm-hmm. Because this particular portion of the tax law is not so hot for employees.
No,
correct.
I agree.
Right? Okay, let's go back to our emails. What do we got?
I saw. Next time, Justin from Buffalo, tax lady. I have a rental property with a mortgage. Is it true that I can't deduct it anymore?
Well, okay, that's part of the confusion. Employee business expenses are no longer deductible as an itemized deduction. Okay, if you are a statutory employee, then your expenses like an insurance agent are still deductible, but they're on a Schedule C. If you have any other business expenses, such as on a Schedule C, rental income, partnership, those expenses are still deductible with a change in the meals and entertainment, okay? But those expenses are still deductible on a Schedule C, on a partnership, on rental property, including mortgage interest. So anything to make a net profit is still deductible. So we wanted to make sure that those things are clarified. The only people, the class of people that are getting the boot, so to speak, is employees. Right. But self-employed people that are in partnership, people in corporations, they're still deductible but not if you're unemployed.
So Justin would be in good shape. He
He's
could
in good shape.
he could deduct that mortgage interest on his Schedule E.
That's
not
exactly
a problem.
right. And the other thing, let's
Pass
tell
through.
Justin that if he had a net profit on his rental, he's going to get a brand new deduction.
Were you going to say that, Chris?
I was going to say his property taxes are not capped on the Schedule E either, where we're getting a lot of questions on that as well.
That's right. But explain the pass-through for Justin.
Sure. On any business, meaning from a corporation, a C corp or S corp, a Schedule C, meaning you're self-employed, a single owner LLC, or rental property starting in 2018, if there is a profit, there could be a 20% write-off of your net profit against your income. So
if Justin had a fourplex, let's say, and his net profit was $20,000, he'd end up with a $4,000
subtraction.
Right, after his before his adjusted gross income. After his adjusted gross income deduction. So if he were in the 22% bracket, he'd save $880.
Right.
Right, and that's brand new.
And I explained that to somebody who I was doing their return this year because they were going to be a little short because he noticed that they're getting extra money in their paycheck. And I was like, you're going to be short at the end of the year. But then I took into effect that he always has a profit on his rental. And so he's going to get that 20% pass through. And so that would make him better, actually.
Right.
Yep.
So, and again, if you're somebody with a business and you're wondering, now C Corps, I know you kind of threw that into the
C Corps have
mix,
different
Chris,
tax
but if you have a
rates.
C Corp, you're getting a great big tax break. So they're not doing the pass through on a C Corp.
Right.
But I want to say this, many C Corps should move to an S Corp.
Yeah, I know I had a client today. Her and her husband's been in business for 20 years, and they're a C Corp. And I said, why are you a C Corp? I don't know. That's what they did. I said, well, do you make money? Do you lose money? She goes, well, the last 5 years we've been losing money.
And so they haven't been able to take any of the losses.
Right. I said, that just stays out there in space until it's ready to be used, till you start making money. And I don't want to say your husband's getting old, but he's getting up there in age, and being a landscaper, he's probably going to start looking to get out of it. So those losses may not be used. So
Right.
You may want to switch to an S Corp right now. So she's going to come in again with him to do another consultation so he understands what's going on.
And it's very simple. To move from a C Corp to an S Corp, of course, the fiscal year is a problem. You can't have a fiscal year. But that's 1 year correction. You do a short year fiscal year and then the rest calendar year. You do a simple form to make the election, and then you're only taxed once. And any losses that your corporation generates is deductible in the year it's generated. And secondly, any income that you get is only taxed once, whereas a C Corp pays double taxes. The corporation pays taxes, and when you take the money out in a form of a dividend, you pay again.
Yeah, and another thing that we just said in that big loop of conversation is right now, because the tax rates have dropped, they've been putting more into your paycheck. And so you really want to pay attention to that because maybe you're getting too much in your paycheck right now and you might be short at the end of the year if you can't, for instance, take your job expenses or your property taxes are capped. So you really want to sit down and calculate to see if you're getting too much so you're not cut short holding the bag at the end of the year.
Right. Okay, next question.
Well, we'll stick with rentals. This is from Ben. I bought 2 doubles on the west side of Buffalo about 10 years ago. The one I live in and don't rent out the upstairs. The other has been a great investment property. We only paid $45,000 apiece for each. I'm looking toward retirement and want to know, is there anything you can think of for me using the new tax laws?
First of all, on the west side is like the gold mine, right?
Yep.
And actually, much Buffalo real estate right now is a gold mine. And you can't say what's going to happen 5 years from now, 2 years from now, 2 months from now. We only know what's going to happen now. Right now, there's a shortage of good property in the Erie, Niagara County area, but especially in Buffalo. Kids coming back to town just think it's so cool to be urbanites, Mm-hmm. So those West Side properties are selling for $300,000 and $400,000. So what I'd suggest, it's Ben.
Correct.
That Ben would do is sell his personal residence, okay? Because the first $250,000 in gain is going to be taxable, half $1,000,000 if he's filing a joint return. I don't know if he's married or not, but so that would mean that he'd pretty much get out of the one that he's been living in tax-free. Doesn't have to buy another thing. He can go around the world with the money, but he's looking for retirement, so this would be a great opportunity to use that as a nest egg for the future. Then move in to the rental, and if he doesn't like tenants above him, just convert the whole thing on the new house into a rental, into a personal residence, and he has skinned the cat on the personal side, made that money tax free, and now he's got a $400,000 another personal house, and away he goes. So he doesn't have to be a landlord anymore. Anything you guys want to add to that?
Yeah, well, if he does move into the other one, the only thing when he does sell it, if he waits 2 years, would be he would still have to recapture the depreciation, which is about $10,000.
Right.
So, but paying tax on $10,000 compared to $400,000 or $300,000.
And it's
He could
capital
always
gain,
do
right?
an exchange, right?
Or he could do an exchange,
Yeah,
right?
yeah.
But that would mean he'd have to stay investment for investment, or
still be a
rental for
landlord
rental, and this was
Right.
now converted to personal. But the thing is, it's like unbelievable. If he would have sold the rental and had the $300,000 gain or $400,000 gain on the rental, it would have cost him upwards to $100,000 in taxes. This way, it saves Ben $100,000.
Yeah, and then to reiterate what Chris said earlier, whereas on the Schedule A you can only do your property taxes SALT up to $10,000. Now you could do all of your property taxes if they were being phased out on the Schedule A. You know.
Yep. And we have to take a break for the news, a hard break for the news. We will be back after these messages and the news.
Hey, this is Esther Gulius, the tax lady from Ask the Tax Lady, News Radio 930 WBEN, and we are giving you the best information about the new tax law and how it affects you. And if you have any questions or anything we say during the show spurs your memory, because this time, or a question, this time we're not taking live phone calls. We're doing emails that'll give us an opportunity to really chew up the changes in the tax law so you understand it better. But during the week, if you want to call in and talk to a person about your personal situation, our phone number is 632-7886 in our at corporate, and we're open 9 to 5 Monday through Friday, and we're not open on weekends anymore because we
don't have to
tired.
be.
We're enjoying.
Yeah.
We're enjoying only working 40 hours a week. And again, you can go to our website at egtax.com, ask the tax lady and ask a question, and we'll answer you right back.
Right. And
so, okay, let's go back to anything you want to talk about, Chris, from
Yeah,
before?
I wanted to say, I know it's doom and gloom out there this weekend right now, but we do always have our summer series that we do on the radio, and people love it, where we bring in experts from different fields to come in to enjoy the hour with us and answer your questions on bankruptcy, on estate planning,
Real
on
estate
insurance,
exchanges.
real estate. So we will come up with more dates and let you know when our guests.
Yeah, and then we're also going to do a super seminar this year in September, and so it'll have a lot of those components that you just talked about. Those guests will be in the super seminar, and so more information will be found on our website, our Facebook, and our app. So stay tuned, and we'll announce it on the show.
Absolutely. Okay. Anything else before we go on to another question?
No, I think
that's
that's
it.
it. I got Sam J. from Amherst. Esther, with the tax changes, does it affect my earned income credit? My family and I count on that money each year, and I can't begin to tell you how much that would affect our household. Is that going to change?
And not only is it not going to change, they've kind of juiced up the credits. So now if you have children, you're sad if the kids turn 17, but we suggest you continue to feed them because if they're going to college the next year, you'll have a big credit again. But for 1 year, the kids are unfruitful from a tax standpoint. But kids under the age of 17 are now worth $2,000 with a refundable portion of the child tax credit of $1,400. That's up from $1,000.
Right.
So, the kid's not, assuming he has some wages here, and I think they even reduced the refundable portion down to like $2,500 in wages. So, So you have the earned income credit and the refundable child tax credit. So if you have 2 kids under the age of 17, you're going to get another $800 over and above the earned income credit. So
that's been something people have been waiting for a long time. And not to mention, I've done lots of people married filing separate because they would lose the child tax credit because the ceiling for losing that was about $130 for a married couple. Now it's going up to $300,000+. So the chances of losing or phasing out that child tax credit is really becoming more difficult, which is a good thing.
I mean, it's a sad thing when you say to people, the best tax break I can give you is go and make some children.
Right, right. And make sure they don't get over the age of 17.
That's right. So good news for people that are upper income people that have lost the child tax credit in the past. Now, I believe it's up to $400,000 before it's fully phased out. You get $2,000 for children under the age of 17.
Yeah, when I was planning this year with my clients, a lot of them, they wouldn't be able to take as much of their state and local taxes and the job expenses, but the fact that they got $2,000 a child, that really saved them, which was a good thing. And then the refundable portion, as you spoke about, was really good too.
Right. Okay. Any other questions, guys?
On this one, nope.
But then I've got Chris has a question.
Dennis writes in, Dear Esther, my financial advisor keeps telling me that I should contribute to a Roth IRA. I have no pension or 401k available. I hear you on Saturdays tell people, take your money now. Can you please explain?
Yeah, okay. So right now the standard deduction married joined is like $24,000, and you get an extra like $3,000 if you're a married couple, for being over 65. So that means at 65, you don't pay taxes on the first $27,000 there and about, very close. All right. So let's say that, excuse me, the only source of pension that you have is a pension, a 401k that you contributed to. And so basically, let's say you have a little nest egg of $1 million and you're taking out about $15,000, $20,000 a year right now, plus your Social Security. Well, till you get to $27,000 taxable and your Social Security is not going to be taxable, you pay 0 taxes. So if you do a Roth, you're giving up the tax deduction up front, and when you take the money out, you don't get any benefit in the rear.
Yeah,
so you do get it in the rear.
Yeah,
because you're not getting anything.
You're losing the
so
money.
You're shooting yourself in the foot up front, and you aren't getting any benefit in the end. So the Roth is doing you no good.
Yeah, Liz had a client yesterday, and their broker, they filed an extension, had them convert items to a Roth, and they left owing like $5,000. And they were just so brokenhearted. And correct me if I'm wrong, you used to in 2017 were able to recharacterize to the end of the tax year.
Not anymore.
But not anymore. So I think the point is, before you pull the trigger, make a phone call and check with us, because you don't have that luxury anymore.
I know that financial advisors are just geniuses at finances, but I don't think they're especially geniuses at taxes. Right. So I will tell you, if you know anybody that's thinking about moving from a traditional IRA to a Roth so that they can make it tax-free when they retire, which it'll probably be tax-free anyway, okay, give EG Tax a call. We don't charge you. You'll get a different perspective. Some of these financial planners, all they do is regurgitate what they learned in training, and they don't have the in-depth knowledge that we do about taxes. If you're not getting a benefit for a Roth when you are taking it out, and you lost the benefit when you put it in because you made it you didn't take the benefit when you put the contribution in, or you did a big recharacterization, you moved it from a traditional to a Roth and you paid all those taxes up front, that's not a good financial plan. Mm-mm. It's better to leave it as a traditional. You'd be surprised. And they're moving up. The other thing is every year they add to the standard deduction, so it gets bigger and bigger. Yeah. So until we see the worm turn, like for instance, if a new administration comes in and they change the law, but right now, especially with the change in the tax law, a Roth, unless you have a New York State pension or a local pension, you're a teacher, got a government pension, most of you are never going to have that kind of a problem where you need to be into a Roth.
And then I can tell you, I do some young kids, and they work at little tiny jobs. One of them is a pastor at a church, and he was advised for his simple or whatever contribution they have at work, he's putting money into a Roth. And this is a kid who makes $25,000 a year, and
he'll never, ever,
No.
unless he gets a mega
I
church.
told him to change
and,
that.
And he, gets on TV. But I mean, right now, you can only know what you know based upon your situation right now.
Yeah, and then actually this is telling, in my opinion. In the tax reform, they were thinking of taking it away where you could no longer deduct money from your 401k or 403b.
There'd be no more pre-tax.
Pre-tax, and so they were toying with that. And so in my head, if they're toying with something, it's a benefit to the government, and they're trying
You
to
think?
Yeah.
Yeah, I mean, and that's a really great point, because when they say, don't take your Social Security till you're 70.
That's what I was just going to say. Well, as long as we're on a soapbox, how about that one? Should I wait to collect?
Don't take your Social Security till you're 70, and make sure you put your money in a Roth. I think that everybody's drinking the Kool-Aid.
Well put.
Right?
Yeah. I mean, going back to the Social Security thing, we hear, should I take it? Should I not? What should I do? Because everybody tells me I gain 8%. But the whole thing is, you're gaining 8% on fictional money right now. Because if you die before you reach age 70, you gained nothing. You have no money for your beneficiaries or your spouse. Where if you were to take the money at age 63 and you were to die at 69, if you had $20,000 a year times 6 years, that's $120,000 you could have in the bank for your beneficiaries or your spouse.
But how about if your spouse passes away and you don't take the money, they don't approach you and say, "Here's the money you missed out"?
At the funeral. I'll give you a specific example. Let's say you're somebody at 62 that would be getting $2,000 a month. So $2,000 a month in Social Security times 12 is $24,000 a year, times 4 years is $96,000. And you say, no, I'm not going to take that $96,000. I'm going to wait till I'm 66. All right. So you just leave it on the table. All right. $96,000. The 32% increase that you would get is $76.80. It would take 12.5 years to break even. So at 66 and 12, at 12, I got my at 78, you would break even. That would be if you wait till you're 66. Even worse if you wait till 80. So the bottom line, at 78 and a half, you'd break even. If you pass away at any point in time before that, you've lost money.
Yep.
Yep.
So you really have to consider what you want to do and put a pencil to it. Don't just listen to, because I know we all think we're going to live forever, but all of us leave
this earth at one point.
Yeah, at one point in time, there's going to be a grim reaper at all of our doors.
And people don't realize too, with this money, you could have put it in an investment account and made extra money as well. So there's a lot of different variances. And when I had a financial person in my office the other day, and I showed him our calculator on our website, how to calculate out the catch-up when you break even. And I said, so for this example, you're 82 years old. At 82, what are you more concerned about? And he goes,
nursing home.
A nursing home. I go, so then who wins? The nursing home. So there's a lot of different things.
It's true. And let's face it, whatever income you saved till you're 82, if you go into a nursing home, they're taking it.
Yep.
Oh, anyway, it makes me crazy.
Yeah.
It just makes me crazy.
Before
it's so sad because there's so much bad information.
Yeah, before the break, I'm going to lead into a question, and then we could talk about it later. Esther, she asks, I've been claiming my mother for 5 years. I was just told that I can't anymore under the new tax reform because of the tax changes. Please tell my brother he's wrong, as usual. And that's Emily.
All right, we're going to take a break right now.
Yep.
and then we'll talk about
We'll
it
be
on
back on
the
the
other
other
side.
side. Hey, I'm Esther Golias, the tax lady from EG Tax, and we're talking taxes. And this week, we're not taking your phone calls. We are answering emails. And Tiffany had just before the break kind of given us a teaser about losing the ability to claim your parent or any dependent on your tax return. It is changing, but the interesting thing is they're still single, they're still head of the household, they're still married joint, and so we don't know how they're going to identify what a qualifying individual is. I don't know whether there's going to be a special form for them to figure out, but in this case, I think her name was Emily. Emily will still be head of the household if her mother, if she's maintaining a household for her mother and she's her qualified individual. So she's still going to get the standard deduction in her case of $18,000, and she'll qualify for a brand new credit.
Ta-da.
And this is when they're doing their postcard thing, they aren't telling you about all these other changes. So Emily would get
Your brother's wrong.
$500 family credit. Because of her mother, and so she isn't taking her mother as a dependent and saving the $4,000. She's getting a $500 credit, which pretty much is the same as the dependency.
Right, and then not to mention if you didn't claim your mother, you couldn't be head of household, so then you lose the $6,000 extra in the standard deduction for head of household over
Right.
single.
So she's definitely, Emily, you're going to make out.
Yeah,
Right.
so you're right. You're right. Your brother is wrong as usual.
But you
as
know,
said.
here's the thing: there's so much disinformation out there that, and I think that they really wanted. I don't know whether Trump really hated his accountant or what, but he made it sound like accountants were going to be necessary. My God, can you imagine if you would leave some of these credits on the table?
No, like Chris said, you would have a reduced standard deduction. You'd have an increased tax,
Right.
and then not to mention the new family credit you'd be losing. So
Yeah, $500.
yeah,
You know.
just one little.
Okay,
idea.
what else we got here?
Dear EG, in 2008, I think, I got the new home buyer's credit, and I have to pay it back. How many years do I have to pay it back for? You know, if I would have waited one more year, I wouldn't have had to pay it at all. And what if we sell the home? Do I have to keep paying it back? Also, finally, if we buy a new home, is there a new home buyer's credit now? Larry
Okay,
from New
would you guys want to answer that?
Well, it's 15 years that you have to pay it back.
It does seem like forever, doesn't it?
Yes.
Every year you get done with the tax return and the computer goes, wait, he's got to pay back the $500.
Right.
But it was such a blessing for them.
Yep, it was an interest-free loan.
Yep. You know, and it's 15 years. This is like year 8 of the payback. And, you know, every time I ask people, do you want to pay? Because they're like, oh, I got to pay that $500.
Oh, that's a
do
good
you
question.
Do you want to pay more?
Oh,
you
that's a
can
really
pay
good
more
question,
to get
Chris.
it done earlier. And no, why would I do that? Well, why are you
Yeah, so you
complaining?
figure it was $7,500 divided by 15 years, which is $500 a year, right?
Yep.
And if you sell your house, let's say you bought the house for $100,000, and it's unlikely in this market, but let's say that the house is only worth $90,000 when you sell it. Because you're selling it for less than you paid for it, then that pretty much wipes out that $7,500.
That's right. You won't have to pay any more of it back.
And there is no first-time home buyer's credit anymore.
Right.
Right.
Right. I think that was around 2008 when we had that big bubble and all those mortgages were writing mortgages that they shouldn't have written. And so it was an incentive to stimulate the economy. And so that was.
Which brings me back to the here and now. You only know right now what's really going to happen. Everything changes. Life is like a river. You're riding on a river and everything changes.
I just amended.
If you're looking at making some money and your house is worth a lot more than you paid for it, and I'm going to tell you, you people listening, your house is worth a lot more than you think. And there is a need for houses in the market. Sometimes there's 15, 20 people making offers on your house and they're buying it for 20 and 30,000 over ask. Now is the time to sell your house. And if it's your personal residence, you can, the first $500,000 is tax free if you're filing a joint return. And you can do whatever you want with it. You can buy a house in Florida. You can put it in the bank. You can put it in investments. It is a great time to sell real estate. Now, next year, it may not be true.
Right.
And if you wait till next year and say, "Oh, I should have done it last year." Hey, once the door closes, it closes. But right now is a great time to list your house.
You just talked about the fact that they make changes. You think you're going right, and then you're going to go left, and you're going to do a sharp Louis. And so during the middle of the tax law year, 2017 and 18, they made changes where mortgage insurance and tuition and fee adjustment to income and energy credits were still alive. So I just did an amendment yesterday for somebody who got a corrected 1098 where originally their mortgage insurance wasn't listed on the 1098, and now subsequently it was. So don't forget to make those changes to your return because they changed the tax law halfway through.
Yeah, so if you were doing your tax return in January or February and you were paying MIP, at that point in time they said it wasn't deductible. Then in February they said, no. By the way, remember when they were doing that budget reconciliation, they didn't want to shut down the government? That's when they snuck in all these tax law changes. And then they said, oh, wait, you can do it now. Mm-hmm. So people that filed early that pay MIP or had energy credits or had tuition and fees deductions, you can amend your return and get the money back for 2017.
That's right.
Right?
Yep. And, we brought up earlier, if you get letters, don't pay the letters, bring them in. We had somebody this week who got a letter saying they owed an extra $250 for the first-time homebuyer's credit. And we're like, how? She goes, I was the only one on the house. When I bought it, I got married 2 years ago. Well, when we called the IRS said, well, now you're married, so you both owe $250.
So sometimes you have to teach them tax law.
Right. I mean, It was just amazing that the person at the IRS was, oh, no, we're right. No, you're right. And they wouldn't budge. They wouldn't listen.
So I got to type up a letter.
Yep. We're writing a letter to the IRS explaining tax law.
Yeah. I can't imagine.
Okay, what else we got?
Tax lady, my son is starting his new job at a major bank here in Buffalo, a great entry position. What do you suggest he do to get started in the right direction? He doesn't listen to me. Maybe your advice would be better taken. Mary Ellen from Cheektowaga.
Okay, so first of all, don't you think the first thing the kid ought to do is go to HR and sign up for
the 401k?
For his anything he can get into for his
pension plan. Mm-hmm. Yep, definitely. Use any.
That's the first thing. Then the second thing is, don't over withhold. Don't have so much money come out of your paycheck that you get a gigantic refund at the end of the year. They're basically using your money all year long. It eliminates your ability to buy things, or many times it causes you to use charge cards because your money's going off to the federal government that they're going to give you the money back at the end of the year. If you're lucky, if they aren't sending you letters asking you to prove everything on your tax return.
Not to mention with identity theft on the rise, I have one of my clients, she gets Social Security and she has a pension, and she does over withholding in her Social Security because she uses her refund as a savings account. She says she's a terrible savings, but 2 years in a row, she's been a victim of identity theft, so her refund is held up for months. And so I said, please change your withholdings. And she said her boyfriend is now opening up a savings account, and he's teaching her how to save at the ripe old age of 65.
But that's good.
Yep, it's really good.
Change, it's all about change.
Yep.
To continue to do what you're doing and expect a different result, because you're going to get what you got.
Yep.
If you continue to do what you're doing, you're going to get what you got. So if you want to have a different result, you have to do a different thing.
And speaking of identity, what were you going to say, Chris?
Oh, I wasn't talking about. I was going to say another tax savings, depending, which we see now is a lot of companies going to high deductible plans, which opens up HSAs. Mm-hmm. So Mary Ellen's son could also put money in his HSA where he may not need it, but it's a form of a savings account because that money just carries forward year after year. And later on, when he's 65, I know he's only 25 now maybe, but that could be used as an IRA in the
Right,
future.
another type
So
of pension
it's
plan.
another type of
I mean, the
pension plan.
bottom line is, he needs to have that conversation, and I hope he would have it with his mom, about what is his goals. Because right now, that first job, you just think, well, I'm going to go get the car. I want to get the girls. I want to have a sharp place to live, maybe go on vacation, and that's, your money is to be used for your benefit, but you need to save some money for the future. There are very few people that have nest eggs for retirement, and if you don't plan on dying, you really need to have money set aside.
Yep.
I mean, dying.
Yeah.
I mean, you're going to die eventually, but I mean, as a young person, right?
Yep.
Because someday you're going to want to. There are people that are listening that'll probably never retire,
And then
because they
also-
don't have any pension plan.
Right. Another good thing is a lot of banks have first-time home buyer savings helps, and so they'll actually give you incentives. So I would encourage this young gentleman to sit down with the bank and consider, his direction of getting a house and moving in that direction and saving
And the other
for
thing
it.
is, he needs to live below his means.
Mm-hmm.
Keeping up with some of the most impressive people I've seen are people that live below their means. They don't have fancy cars, but they have fancy investments. I will tell you, and you'd never know it because they're just like regular people. But they have made decisions as they were, as their life
look at
unfolded,
Warren Buffett
save money.
Warren Buffett drives this old car and lives way below his means.
Yep.
And Chris is saying we got to wrap up the show.
All right. Hey, I'm Esther Gullius, the tax lady from EG Tax. If you need any tax help during the week, you can call us at 632-7886. You can go to our website at egtax.com. Until next Saturday, I'm Esther Gullius with Tiffany Fabian and Christopher Fabian. God bless you. Have a great week.